And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to, well, it's the Tuesday edition, technically speaking, Tuesday edition of the Real Investment Show. Of course, our article is out today on the website talking about blowing up the everything bubble. Yeah. That's the headline for today, and basically just talking about the fact that we have this time very differently than what we had before. .com crash, we had the .com bubble and the real estate crash. We had real estate. Well, now we've got bubbles in tech stocks. We've got bubbles in SPACs. We've got bubbles just pretty much everywhere. Of course, rising interest rates, the big problem there, and that's what ultimately causes the problems for the markets. Is that whole excuse that we've been using now for the past really decade that low interest rates justify overpaying for assets. Well, when interest rates rise and they rise quickly, tends to undermine that bit of analysis. So anyway, that's on the website today. We'll get some more of that in more detail in our 3 minutes on markets and money that we'll post after the show today. A couple of things here. As we talked about yesterday, the markets have been setting up here. The money flow signals were starting to turn negative. Starting to talk about getting a correction, and that correction started yesterday. It's going to continue into the markets today. The question is of course, how big is this correction going to be? Is it going to be just a 2-3% correction, then we're back into action, or is this potentially setting up for a bigger correction? That's the problem with technical indicators. What technical indicators don't tell you is they'll tell you that you're going to get a correction. What they don't tell you is how big it's going to be. And that's the hard part about navigating these corrections when they occur. Now, yesterday the markets did begin this sell-off, and again we talked about the risk here of a retracement back to short-term moving averages, previous levels of support, those type of things. We actually got there yesterday on the S&P. The NASDAQ had a much bigger decline overall as well, and is really coming down here. And the interesting thing here is that for the NASDAQ, this is where a lot of the money's been kind of chasing into, has been in a lot of these technology stocks. This has been part of this idea about the reflation trade, right? That in an economy that's recovering from, the recession, that you want to own companies that have the ability to generate earnings really kind of no matter what's going on. Well, kind of yesterday, that whole theory kind of unwound as we saw money really flowing into really two areas primarily in the markets yesterday, which were finance and energy. And now this is this whole idea of higher interest rates, higher inflation in the economy, oil prices coming back, that reflational trade as interest rates start to come up, that's better for banks. Of course, higher oil prices, better for energy companies. So those two areas really brought in a lot of money flow yesterday. We saw big moves in finance and energy yesterday. A pretty good drubbing going on really in technology stocks across the board. Microsoft, Amazon, Facebook, you name the big companies, they got hit pretty hard yesterday. NASDAQ was down much more yesterday than the S&P and is getting very close to its 50-day moving average. Now, this is going to be an important level of support for the NASDAQ. If it fails to hold that level, then we've got a much bigger correction coming because it is a long way for the NASDAQ to get back to the 200-day moving average. So again, when you start talking about more kind of traditional levels of support for markets, those tend to be moving averages. The 50-day, the 200-day tend to be the most critical. So again, if you have a bigger correction here, and today's really going to kind of be the telltale day, right? We're going to have another kind of weak open for the NASDAQ this morning. So we down over another % this morning. The question is going to be, how far does it go? Is today it? Or do we have much more to go here? And now if we take a look at money flow indicators, particularly for the NASDAQ, right? Money flow actually went negative yesterday. Now this is different than what we've been seeing with the S&P, where money flows have been negative, but the actual money flow process itself has remained positive this whole time. Now it's deteriorating as well in the S&P. Now this is all suggesting, as we've been talking about over the last couple of weeks, that this could lead to a little bit bigger correction, not only in the NASDAQ, but also in the S&P as well. And particularly this is the case if we jump out and look at a longer term basis of this and look at weekly money flows. Those have turned decidedly negative here as well. And on the NASDAQ, particularly as we see that weekly sell signal kick in, again, when we go back and look at longer term levels of support, it's a long way to go for the NASDAQ to get back to those levels of support that have typically been important levels for the market. So again, it's just the deviation in price. We've had such a big move up really since the March lows that markets have really gotten deviated from their long-term moving averages. So that correctional process, when it occurs, is going to be a lot bigger ultimately. Now, I'm not saying that's going to happen today or next week. All I'm saying is hey, pay attention here, because we do have money flow sell signals in place that have typically kind of corresponded with bigger corrections. So this correction, don't dismiss it. It could be bigger than you expect, and we'll kind of watch what happens with the action today. Does the market recover from the open? We're going to have a weak open. Does the market recover from that and start to move back up? That's going to be the thing we want to watch today. Now, the other kind of big news, of course, is Bitcoin. Bitcoin's going to be down rather sharply this morning. Had a big correction yesterday. It's going to be down about another 13-14% today. Again, this is kind of another one of those areas of the market where there's been a lot of speculation. You've had a big move up in Bitcoin here. This has been kind of the whole talk. Yesterday, Janet Yellen coming out, kind of putting a ding in the theory of Bitcoin and its viability longer term. So again, that's, we talked about this before, is that the one problem for cryptocurrencies ultimately is central governments. No government is going to allow another currency to undermine its basic currency itself that it uses, right? So the dollar is the reserve currency of the world, right? We depend upon that status in the U.S. for a whole variety of transactions, as well as economic stability and most importantly, national security. So you really can't afford to allow, if you're a government, can't afford to allow a decentralized currency to exist that becomes a dominant player in the market. So this is why you're starting to already hear some talk. You've heard it from the ECB. You've now heard it from Janet Yellen as well. There is going to be a government pushback at some point against Bitcoin, and that's going to be really kind of a challenge for that in the near term. But right now, there's just been a big move in Bitcoin, very overbought here at the moment. So again, seeing a bit of a pullback here, not surprising. The question will be, is it just a small pullback and again another rally, or does this, like the stock market, have a bigger correction overall, right? This is the one thing, and this all comes back to the basic thing that we talked about yesterday: interest rates. Interest rates are really kind of the linchpin to this whole dynamic. It's also really the kind of the crux of the article that we have on our website today, talking about blowing up the everything bubble. Everything that we've got going on, whether it's real estate, stock market, commodities, has all been driven by ultra low interest rates. This whole interest rate environment has been at near zero interest rates. We've taken on a tremendous amount of leverage in the economy because of low interest rates. And of course, what happens when interest rates rise is that undoes all of that basic theory. That whole premise behind the bullish stance of the market was based on low interest rates. So all of a sudden, overpaying for valuations, companies being able to refinance, more importantly, zombie companies, which are these companies that survive on low-cost debt, all that becomes very problematic when interest rates start to rise. So again, with the increase in rates that we've had here over the last couple of months, that may be one of the reasons the markets are starting to kind of wake up. This was the crux of our newsletter over the weekend. Are the markets starting to worry about higher rates? And Jerome Powell this week, talking for the Federal Reserve, and I'm sure we're going to start to hear some comments from him, but will we hear him start talking about potentially yield curve control? That's going to be a lot of stuff coming up this week. Anyway, quick break, come back. Lots of topics to get into this morning with you right here on The Real Investment Show. Get by the website, get our latest post this morning on our Technically Speaking Tuesday, blowing up the everything bubble on the website now, realinvestmentadvice.com. We'll be right back.
Why can't you see what I mean? I might as well jump.
You're listening to The Real Investment Show.
Spring has sprung, fall has fell, summer's coming, and you'd be well served to join us for our financial spring cleaning edition of Candid Coffee, Saturday, April 10th. We'll help you sweep away the financial clutter getting in the way of your goals and prepare you for the dog days of summer with budgeting and portfolio tips from Richard Rosso and Danny Ratliff. Register now at realinvestmentadvice.com for Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. I'm your host, Lance Roberts. 6:17 as we get the show underway. Headline this morning on CNN. What can people who are vaccinated safely do? Seriously, this is a headline. So,
Slow news day?
well, I'm just saying, what can you, if you've been vaccinated, what can you safely do? Anything, right? I mean, that's the whole point of getting vaccinated, right? If the vaccine is supposed to prevent you from getting the infection, you should be able to go out and do anything you want, right? So, we have a Social Security problem, right? So if you're over the age of 65, start sending out free skydiving tickets to everybody over the age of 65. You can safely do it. You have a vaccine.
You're impregnable.
I'm not talking about getting pregnant at 65.
I knew you were going to go there.
As soon as you threw that word out, right? You knew I would go there.
Go back and review the video. You'll see it flash across his face, folks.
It's like, I can't let it go. I was seriously going to let it go. And then I was like, I can't do it. Anyway, so the whole point, though, is that the vaccine is supposed to make you, immune from getting the disease.
But now,
you're bulletproof. I know, right? Now just go out and get back to doing life. But it's interesting, right? The whole thing is now it's like, okay, great, you got the vaccine, but, well, you still need to be very careful, right? Look, here's the point. We want to get the economy back on track. We want to get things going this morning and here's headline from yesterday, right? So headline from yesterday was airline and cruise stocks surged to start the week, right? Had a big week, had a big day yesterday in areas of the market, as I was talking about at the open, right? Energy did well. Finance did well because of rising interest rates, which are good for banks. But this is this whole idea of this reflation trade in the economy, right? Inflation's coming back, the economy's recovering, people have money to spend. And so let's go buy banks and airline stocks. Well, hang on a second. Here's the thing about this. First of all, these companies, just because they sell cruises today. So let's just say I'm a cruise company or an airline company, right? So it doesn't matter. So I sell a ticket today, right? So I get that revenue today. That doesn't make up for an entire year's worth of lost revenue. I never get that back. That lost revenue is gone. I don't get to go sell airline tickets for last year. I can only go forward from what we're doing from here. So, when you take a look at this idea that, hey, great, the economy's going to come back, we're all going to start traveling again, that's true. The question, though, that you should be asking is are we going to get back to the same level of traveling anytime soon that we were before? Are people going to be not only willing to go out and do those things, which, of course, that answer is yes, right? As soon as people feel comfortable again, and again, the media has a big hurdle here because they're the ones that have been promulgating this whole fear of the virus, right? It's made it far worse than what it actually was. And, when you talk about a virus that has a 99.2% survival rate, that you listen to the headlines and it's like, okay, we've got to stay inside, got to lock everything down, and it's got it, right? But that had economic consequences by doing that. The question now is because of the headlines every day. I mean, literally every day on CNN, as an example, headlines of how many people have died and how many illnesses there are. Who's going to want to go travel in that environment, whether you've had the vaccine or not? So the question is that at what point does the media start to come back, and social media as well? Social media is just as bad about this as mainstream media, as instilling this fear. This isn't economically a good thing, but what it does is just shift more and more control to the government. And this is what, Americans haven't realized here, that you've been gaslit for about the past 12 months. And you have shifted more and more of your freedoms and control to the government, which is beneficial for them, not so much for you. But here we are talking about wanting to get the economy back going, right? We want to get everything back to normal. We want to get people back to work, those type of things. Well, in order to do that, you've got to allow the economy to start to function. We talked yesterday about equality of opportunity on the show. at some point, you've got to allow people to get back to doing what they do, whether it's small businesses, medium businesses, large businesses, consumers. You've got to allow them to get back and let them start doing it. Let them take the risk that they want to take. Everybody that runs a business takes a risk. And you saw this during even when we were in the depths of the shutdown. You saw small businesses, small business owners pushing back. And they would open up their business anyway. They're saying, hey, I'm willing to take the risk. I need to do this in order to support my family, keep my business alive, etc. I'm willing to accept the risk. That's what people do. If you allow them, right? If you allow them to take the risk, they will take the risk to do things. Now, the point here is that there's this whole idea that the economy is going to come rapidly back to normal, and we're going to be back to where we were pre-pandemic. We'll eventually get somewhere close to that level, but there has been a large amount of damage that's been done that we're not going to repair anytime soon. This was one of the points that Jerome Powell made last week, talking about employment. And it's interesting, for a decade, we've been talking about on the show that, the BLS employment numbers didn't really reflect the true state of employment in the economy because it didn't count the number of people that have just basically fallen off the rolls or were falling outside of the count that occurred with the employment numbers. So the Federal Reserve would come out and talk about, hey, we've got 4% unemployment rate. We were like, no, you actually take a look at the economy. We're more like 7 to 8, that type of thing. And we did lots of reports on this over time, but nobody wanted to pay attention to that because the headline number of the U3 employment report, that 4%, was supporting the narrative of the economy. Made everything sound better. It was interesting last week that Jerome Powell comes out in order to support now keeping interest rates at zero, despite the fact that you've got inflationary pressures coming back. Because remember, the Fed has two mandates when it comes to monetary policy. It is maintaining stable prices, in other words, low inflation, and full employment. Well, you can't have full employment and no inflation. So, with employment, according to the U3 now back down to 6%, and historically, 5-6% is full employment in the U.S. Even now, Jerome Powell is now falling back to, we have to really look at these other factors in the economy, and unemployment is really closer to 10%, not 6%. So it's all about convenience. And this is what the government does, and a lot of these government agencies, is they use whatever data is convenient for whatever narrative they want to spend. And this is why it's important for you as an investor to kind of delve through this, all this headline talk and say, okay, what am I actually buying here? Airlines and cruise stocks are going to recover. The question is will they recover back to levels that they were before? Will people go back to doing what they did before on a regular basis? That answer is ultimately yes. The question is how much time does it take to get there? And how long does it take to recover all the losses they took previously? Because again, those dollars never come back. They're now starting from ground zero because every ticket I sell for a cruise ship or for an airline is now starting from ground zero. This is, I'm selling it for this cruise and this trip. That's it. I don't get to make up what I lost. And so when you start looking at valuations and things like this in terms of these particular industries that don't have the capability to recoup previous losses, this is kind of the dynamic. Now, right now, it's a lot of the speculative chase, right? People are running up these stocks strictly on speculation. But, if you're starting to think about long-term investing and these type of things, there's some things you want to consider. With the economy, yes, we're going to recover, but there's a lot of people out of work that are going to remain out of work. The labor force participation rate will remain lower than it was during the previous decade, which was lower than it was from the previous decade before that. We've had this continually, the amazingly shrinking labor force participation rate over the last 20 years. But these things all have dynamics within the economy, and this is why we continue to have slower rates of economic growth. There's an interesting article out I'm working on right now, but there was an interesting article out yesterday talking about the expected rate of economic growth this year. And there's lots of exuberance about this, right? And this kind of goes back to this whole idea of airline and cruise stocks. We're going to have this amazing economic recovery this year. 5%, 6% growth rates nominal before inflation. We're going to see these amazing growth rates in the economy this year. Why? Because of stimulus. We're going to give, another $2 trillion worth of stimulus, and people are going to go out and spend it in the economy. It's great. But then you look at what their projection for the next year is, right? So this year, 2021, 5 to 6% economic growth. Fantastic. Next year, back to 2%. And that's where we've been stuck, right? We continue to have these little spurts of growth because of things that we do. We do QE. We have, 3 hurricanes within a year that requires a lot of rebuilding. So we get a spurt in economic growth because of that. We have these little things that occur over the last decade that lead to these one-year pops in growth. And we're like, great, economic growth is coming back. And the next year falls right back into the 2% bracket. Because that's a function of where we are economically, population-wise, employment-wise, debt-wise. All these things lead to lower rates of economic growth in the economy. So when you start thinking about these sectors of the markets that are recovering, the question is the sustainability of these recoveries as well. Be right back after the break.
Listen anyplace, anytime at realinvestmentadvice.com.
Spring has sprung, fall has fell, summer's coming, and you'd be well served to join us for our financial spring cleaning edition of Candid Coffee, Saturday, April 10th. We'll help you sweep away the financial clutter getting in the way of your goals and prepare you for the dog days of summer with budgeting and portfolio tips from Richard Rosso and Danny Ratliff. Register now at realinvestmentadvice.com for Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm Rose Lance Roberts. So we're just talking a little bit about the marriage between the Fed and the Treasury and how all this spending that we're doing in the economy will likely lead to short-term inflationary pressures, but longer-term deflation. And the reason for that is that the money just stays bottled up. It doesn't pass through the system. And this particularly becomes problematic when the Federal Reserve is using processes to keep interest rates from moving higher. And again, if inflation is 4% and interest rates are only 2%, then I'm not borrowing money because I can't make a return on my investment. I'm not going to loan money because I'm going to lose money over time. So, this is really kind of the worst possible outcome economically, is to have these inflationary pressures with interest rates not representing what inflation entails. Kind of mucks up the whole credit system, and the backbone of the entire economy is credit. So this is the one thing I think people are overlooking, and eventually what happens here is that the markets recognize the problem, and you wind up paying a penalty for that. Now, is that this year? Is it next year? Is it the year after? Who knows, right? But there's a point to where this becomes apparent. Most likely to be later this year as expectations for economic growth start getting ratcheted down. Right now, we're seeing a lot of economists out, we're growing 5.8% in 2021. We'll likely have a decent second quarter, first quarter maybe. But then it'll probably start to fade after that. Unless, of course, we keep doing more and more and more stimulus, right? So these stimulus checks, as I was saying earlier, they're great. They cause a short-term pop in inflationary pressures, but it doesn't lead to longer-term economic growth. As an example, if I give you a $600 check and you go pay your electric bill with it, then what are you going to spend after that? And plus, paying your electric bill, which keeps your power on, is awesome. It doesn't produce demand in the economy for more goods or services, right? Because you just went and paid a bill with it. The electric company says, thank you very much. They put it on their books as your bill's being paid. Yes, they pay their employees with it, but they're not going out to hire a bunch more employees just because you paid your bill, right? So there's not the demand equivalent for these types of expenditures. So paying bills, paying down credit card debt doesn't change the dynamic to the economy. Now, this is important also because a lot of this run up over the course of the last month or two has been on expectations of more stimulus, right? So we passed the $900 billion spending package. That led to $600 checks for households, did increase the unemployment benefits from $300 to $400. But there's an important point about that. That's less money than what people got previously. So the problem is that with a reduction in the stimulus, right? So you only got a $600 check, great. That's less money than you got before, which means there's less money to spend in the economy, but the economy is now larger than it was back in March because it's grown from the original stimulus. So the percentage impact to the economy is less because it's less money on a bigger number. Now the concern is, or I should say the hope was, is that Joe Biden gets elected president. He comes into office and he's going to pass a $2 trillion stimulus package. This would include $1,400 checks to households, so I give everybody up to $2,000 total. Increase the unemployment benefits from $300 to $400, push that through to September. That gives some people some more money. So it's all good. Problem is that still got to get that passed. And there's still a lot of moderate conservative Republicans and moderate Democrats, believe it or not, that are likely not to potentially go along with such a kind of a exceptionally big spending package. There are people who are still concerned about fiscal responsibility in Washington, although those are becoming less and less every day. But there's still going to be pushback on that. And so after Joe Biden announced his $2 trillion spending package, that was pretty much almost immediately whittled down to $1.1 trillion. And this morning, JP Morgan says that it's probably going to be closer to $900 billion. That's just what we passed previously, right? So we passed $900 billion, another $900 billion. And this is really kind of where President Biden is about to start to run into some problems, right? He's focusing on trying to impeach Donald Trump. Those articles got presented to the Senate yesterday. Now they're talking about having a trial. That's all fine, right? But they have to give former President Trump his day in court. So that means he's got to have time to prepare, which means we may not get testimony until sometime in February. The point is this is all tying up Senate's time to deal with the trial versus working on passing more stimulus, right? So this is going to delay the time until we actually even start negotiating on a stimulus package. So what's concerning now or should be at least concerning for the bulls is that virtually every major bank right now has already warned of, this idea of euphoria in the markets and we're going to have this sharp increase in economic growth because of all the stimulus. Well, all of a sudden, that stimulus is getting pushed down the ladder. So this means less money for the economy, means less money for stimulus, which, and if you go to $900 billion from 2.9 trillion, somebody's getting cut. Either it's money to cities and states, which I doubt that's going to be the case, because that is pretty much the whole thing that Joe Biden ran on, was to get money to the states and the municipalities, which means that somebody's got to give somewhere. So either somebody's getting less money, either at the state municipal level, or the individuals are going to get less money. Maybe no checks, just extended unemployment benefits, whatever it is. But this is potentially what's coming, which will potentially disappoint markets. And when does that occur? That could be February, that could be March, whenever we get around to this. But the longer this drags out, the less input into the economy. So this is going to start to detract on economic growth, right? But again, we still have to deal with these inflationary pressures because, look, people are lining up right now and they are piling into reflationary trades, basic materials, industrials, expecting really strong rates of economic growth. And the problem is that emerging markets, international markets, which are heavily dependent on a weak dollar, have already run well ahead of whatever potential economic growth you were going to get anyway. So the valuations that people are paying are far ahead of even what the economy can actually produce in the best of circumstances, right? So the markets are priced for perfection. So anything that happens that's less is going to turn up as a disappointment at some point. So again, we'll start to expect to see probably in the next couple of months or so, start to see economic estimates ratchet down. And this is how we always do this, right? We start high, we ratchet these things down. We start high on earnings, we ratchet those down. And by the end of the year, we'll be back into more reasonable levels. But the risk to investors is a disappointment of expectations. And really, that's all markets come down to, is what markets expect, what participants expect, and where it turns out to be reality. Now, at this moment right now, there's a tremendous amount of speculation in the markets, which really defies any type of economic or fundamental analysis anyway. So really what I'm talking about here is irrelevant. As long as you've got plenty of people willing to just take on excess risk for the sake of taking on risk, because it seems to be at this point a no-lose environment, things will just keep doing just fine. The problem is when something happens that changes that sentiment. And now that you've got record leverage, you've got record, speculation in the markets, record euphoria, it won't take much to change that sentiment. And we'll see things reverse in another direction. And then, unfortunately, as we said, this, the reason that we sold and took profits on Friday is that, we're early. Markets are likely to try to keep creeping up here over the course of the next week or so. But at some point, we're going to have a short to intermediate term correction in the markets. Might be a week from now, might be a month from now. That's okay, but it'll happen so quickly that you won't have time to react to it. And that's just the way corrections are going to be from now on, because of the lack of liquidity in the markets and the way that we're all investing now. These corrections are very, very sharp drops. So you've got to get out ahead of time and wait for that correction to occur. And I don't mean, when I'm saying getting out, let me clarify, right? So I don't get emails. We didn't go all the way to cash. That's not what I'm saying at all. We just reduced some of our exposures. We took some of our index trading positions off, took profits there. We're still long our equities. We're still long our fixed income. But we did raise cash, and we're starting to hedge in our portfolios just to protect against risk. When the correction comes, then we'll reallocate back towards equities. But the problem with these declines is that they come so quickly now that if you don't make preparation, you don't have time to change things during the decline. Look, when you go outside, if you think it's going to rain, you take an umbrella. You don't wait for it to rain on you, then figure out you need an umbrella, right? Be right back after the break. I'm your host, Lance Roberts.
Let it fast and fall. 13 metal baby, yeah. Broken looking glass. 7 years so bad now.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Spring has sprung, fall has fell, summer's coming, and you'd be well served to join us for our financial spring cleaning edition of Candid Coffee, Saturday, April 10th. We'll help you sweep away the financial clutter getting in the way of your goals and prepare you for the dog days of summer with budgeting and portfolio tips from Richard Rosso and Danny Ratliff. Register now at realinvestmentadvice.com for Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. I'm your host, Lance Roberts. So there are things that you can look around and see that there's signs of, exuberance, right? There was a comedian for the long time. His bit used to be, "Here's your sign." And he would talk about, it's Bill Engvall. Yeah, Bill Engvall was his name. So Bill Engvall did this whole comedy skit called "Here's Your Sign." And he would just talk about stupid things that people say, right? Like he pulled up in front of an airport one time and he's got skis on top of the roof of his car. And he's there to pick up his family members who have come in, and he's got all the skis and ski gear on top of the car. And a guy stops him and says, "Going skiing?" And he's like, "Here's your sign." But that's kind of the market, right? There's plenty of signs around that say maybe, things are just getting a little bit lofty. And, SPACs, as we've talked about here on the show, are kind of a good example of this. SPACs are these special purpose acquisition companies, which are basically publicly traded shells that people throw money into, and then the company goes out and tries to find something to buy with it. One of the latest ones just announced a couple of days ago is a SPAC to go out and buy registered investment advisors. This is a business where fee compression is getting worse and worse every year. It's getting harder and harder for advisory firms to make money because of fee compression. And you're going to go put all these guys into a SPAC and sell them for a big public valuation market. That's a guaranteed loser at some point down the road, right? That is not going to work out well. But right now, because of what's going on with the frenzy, everybody goes, "Oh, look, it's a SPAC. Let's throw money into it," right? So they're, throw $500 million into this. And the problem, of course, is being able to find the companies to buy and how much you have to pay for them. Another good example of this, Reddit just raised another $250 million. They're valued at $3 billion. Now, Reddit is, quick backtrack here. Reddit is the social media app company that houses and forums for people to go talk about all kinds of stuff, right? There's a forum on Reddit for just about everything. Of course, the most famous one right now, if you're in the financial market, is Wall Street Bets, which is this whole group of traders that were chasing GameStop and AMC and other stocks here recently, and really brought a lot of attention to Reddit. So Reddit said, "Let's go raise some more money." And let me read you a quote. This is from Reddit as part of this. This was a company that in 2019, the company was valued at $3 billion. Back in February of 2019, they just raised another $250 million. Gives them a $6 billion valuation now. But here's the quote. This is the important quote. "We decided that now was the right opportunity to make strategic investments in Reddit, including video, advertising, consumer products, and expanding in international markets." Sounds like a great reason to go raise some capital. Obviously, they have a lot of attention right now. Everybody's looking at Reddit because of Wall Street Bets. But here's the important line of their quote. "Valuations are very high right now. It never hurts to raise money when there's an opportunity to do so, and Reddit had a strong year." Now, this is the important line about this, and this is what's going on with every stock in your portfolio right now. If you go out today and you're going, man, I got to get some more money into ABC company, you are paying a premium valuation for that investment. Now, I know you don't care right now because prices are going up. Man, I can just throw money in the market and stuff goes up. Let me give you an example. We launched a new portfolio model at the beginning of this year called Dynamic Equity. The portfolio is already up 10% this year. One of our positions we bought 2 weeks ago is up 100%, almost 100% as of yesterday. Now, we know there's a tremendous amount of risk in that position, right? But this is what's going on within the markets. So it seems easy, man. I just throw money in the market. It just goes up. It's awesome. This is terrific. The problem is that exactly what Reddit's saying. He says valuations are very high right now. So when a company comes out and sells you more shares or you go and buy more shares, you're buying at a premium valuation. Now, I know that doesn't seem to mean anything to you right now because just prices are going up and hey, we're just printing money. It's easy. This is awesome. But this is the same idea as buying anything else. Let me ask you a question. Would you go to a car dealer today to buy a Toyota Camry and pay $90,000 for it? Now, there's some joker in his car right now listening to the show going, well, I would if it's all in gold. Yeah, okay, got it. I'm talking about a regular Camry off the lot, right? Of course you wouldn't. Why wouldn't you pay $90,000 for a Camry? Because it's not worth it, right? You know, I mean, nothing wrong with Camrys, right? Just a fine car. It's not worth 90 grand. And furthermore, you know that if you buy a car for any price, that as soon as you drive it off the lot, you lose about 20% depreciation, right? So you know that overpaying for that Camry today is not going to be a good investment for you, but that's why you don't do it. If you go buy a house, same thing. You're not going to overpay. You're not going to pay twice as much for a house in a neighborhood where all the other houses are half the price of the house you're paying for, because you know you won't ever get your money back. The entire neighborhood has to come up to that level for you to ever make that money back. We know these things inherently about everything that we do. When we go out to shop for anything, what's the first thing we do? We shop for the best price, right? We go to Amazon. Maybe we're thinking about buying a new TV, right? So we go to Amazon. We see what the price of TV is over there. Maybe we go look over at Best Buy real quick. We can do it all online now. We can even do comparison shopping online and see who's got the best price. We've got price match guarantees. You know, all this stuff, because we want the very best price on anything we buy. We want the cheapest price on the TV. We want the cheapest price on the Xbox, whatever it is, right? We want to pay the least amount of money possible, except when it comes to stocks. When it comes to stocks, we can't wait to just overpay for stuff all day long. Now, there's nothing wrong with that, it seems to be, in the very short term, because prices are just going up. But you have to think about what you're paying for if you're truly a long-term investor, right? Now let's back this conversation really up for a second, because, you know, if you're just day trading stocks, more power to you. You're gambling, awesome, right? That's fine. Valuations don't matter. The only thing matters if you're day trading stocks is technicals. All right, is the price going up? Is it going down? Where's your support level? Where's your stop? That's it. That's all you care about as a technical trader and as a day trader. But if you're truly buying stuff because you're going, man, I think this is a great company and I think I'm going to hold it forever. If you overpay for it, you're going to lose money. And that's just a function of the way markets work. There's a lot of companies in the market right now that will not be around in 5 years. There's some big companies in the market that may not be around in 5 to 10 years because of changes to economics, changes to markets, et cetera. It doesn't mean they're going out of business, but they're going to be acquired. Other stuff's going to happen. But this will all ultimately cycle around back to valuations. And currently, at the moment, we have people paying way more than valuations are worth. And the reason you know this, again, if you take a look at what's going on with SPACs, is a good example of this. People are just throwing money into SPACs with no idea really what the SPAC's going to do. It's got an idea, right? We just talked about A-Rod's new SPAC, right? He's going to go in. He's a baseball player, great baseball player. Nothing against A-Rod. And he's hanging out with Jennifer Lopez. So, I mean, you got that. Nothing wrong with that, right? But now he's going into being he's created a SPAC. He's raising $500 million to go make investments into technology companies and innovation companies, stuff he has no real idea. I mean, that's not his expertise. His expertise is playing baseball. But you know what? If I've got a name and I can go buy a SPAC and I can get people to give me $500 million to invest, great. But that just goes to show you kind of where you are within the exuberance of this market. It doesn't matter. Oh, it's a SPAC. I'll buy it. That's just kind of the exuberance of the market right now. And again, we see it everywhere. We see it in the amount of speculative call buying. We see it in the amount of money that people are throwing into small cap stocks. We're seeing it in SPACs. We kind of just see it everywhere. There's just tremendous numbers of signs of this exuberance and mania in the markets. And again, that's fine. It's easy to make money right now. But just remember that ultimately, at the end of the day, valuations matter. When will they matter? May not be for months. May not be for a year. Which means enjoy the ride while it lasts. Just make sure that you don't forget to get off the train. It's easy to get on it right now. Just remember, you got to get off at some point as well, because if you don't protect all your gains, what was the point to begin with? Have a great day. We'll be back tomorrow for the Wednesday edition of The Real Investment Show. Danny Ratliff will join me tomorrow. A lot of stuff to get into, as well as always. Get by the website. Our latest post for Technically Speaking Tuesday is up, talking about the commitment of traders reports and really what's going on with some of this speculation in the markets. All on the website now, realinvestmentadvice.com. Have a great day.
Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.